Hello, I'm Ethan, a New York organization development coach. I help small to mid-sized businesses achieve or reach maximum productivity and performance in their workforce by unleashing their people's untapped potential, building amazing cultures. I sometimes take a look at entire industries as opposed to just specific organizations. I want to spend today talking about the insurance companies in California, what's going on right now with the Los Angeles fires. So let's start with University of California, Berkeley's Dave Jones, who is the former insurance commissioner of the entire state of California, who was interviewed literally this week about the stakes of the current wildfire emergency and what's going to happen next, possibly with regard to insurers in California and homeowners. So, what's next for home insurance in California after the LA fires? So, citing perilous risks in the residential areas primed to burn, insurance companies in recent years have literally dropped hundreds of thousands of insurance policies, leaving California residents scrambling for some kind of insurance coverage. And with every new wave of cancellations, it's followed by talks and reforms, and yet a growing sense of unease with California homeowners. So that's the backdrop. That's what was going on in the recent past. So now with LA fires in and near Los Angeles predicted to be among the costliest disasters in the entire U.S. history, questions abound. How will California's insurer of last resort respond? What will fires in Southern California and climate change, more broadly speaking, mean for people in the Bay Area? This is, again, a University of California, Berkeley focus. This is UC Berkeley News, so it's very local to the East Bay of California, but it has implications statewide throughout California. So the kinds of concerns that are raised are familiar to Dave Jones, who's the director of Climate Risk Initiative at UC Berkeley's Center for Law, but he was also, from 2011 to 2018, for 2 terms, State of California Insurance Commissioner, where he oversaw regulatory policy and some of the most catastrophic of California's fires in the history of the state. So he has said growing risks and losses from climate change driven events will outrun rate increases. So in his interview with UC Berkeley News, I want to kind of lay the backdrop. So right now, fires are raging in and around Los Angeles. Devastation, literally at this moment in time, is being looked at of upwards of $50 billion. What the question posed to Dave Jones is, given what we know right now with the LA fires, what might the broad effects be on the insurance market in the state of California? He says that insurers have asked the California State Insurance Commissioner to adopt a set of regulatory changes last year, 2024. And he said they said if those changes were adopted, the insurers, would start writing new insurance policies for coverage for people, for homeowners. The insurance commissioner, after a year-long process of debate and negotiation, adopted every single one of the requests that were made by the insurance companies. So here's what that negotiated new set of regulations, most recent in 2024, permitted insurers to have. They were allowed to take a look forward into probability models to determine the catastrophic load of the insurance rate and allow the insurance companies to include all the costs that they pay in reinsurance, meaning their own internal insurance company insurance. So they also asked for, the insurance companies, and got relief from having to pay an assessment if claims made against the California FAIR Plan, which state law in California has to write insurance for those who cannot obtain insurance through insurance companies, exceed its ability to pay. So they got everything. And I do want to say that I have incredible bias. My bias is anti-insurance companies. They're blood-sucking leeches without any moral capacity or ethical construct. And in crises like we're facing right now in the state of California, all they're looking to do is minimize costs, maximize profit. They are the epitome emblematically speaking, of the 20th century command control, shareholder value driving culture. So as the insurance companies got all the regulatory changes that they asked for, insurers should be able to follow through with writing new insurance policies in areas of high risk wildfires. Before the LA wildfires, insurers said that they would be filing for substantial rate increases, meaning they're going to charge homeowners because they were allowed to, because they negotiated that with the state under the new regulations. After the LA wildfires, right now, we're like what, a week plus into this? After the LA fires, with a projected 10 to 20 billion so far in insured losses, the number has far surpassed that because of the wind shifts and subsequently new fires. Insurers will be filing for even higher rate increases. Of course they are. In times of significant distress and duress and stress, what are corporations historically, their dance move, their one dance move has been increase rates or drop coverage. And we'll talk about that. With regard to the LA wildfires, sadly, it was a question of when, not if, major catastrophic wildfires would hit California. Global temperatures continue to rise globally, not just in LA or the state of California. And we're seeing this significant turn to more severe and extreme weather-related events. We're seeing that across the United States, by the way. This isn't necessarily just a California climate change challenge. The fact that this occurred is not something that the insurers did not predict at the time that they actually asked for and got regulatory changes that were even more in their favor. So the LA wildfires should not be a basis for insurers to renege on their commitment to start writing and renewing more insurance in California. But that's what they're doing. They're dropping right now tens of thousands of policies. So what should policyholders and policymakers watch for and expect in the weeks and months ahead in California? Is our current approach to insurance within the state of California, because this is UC Berkeley News interviewing Dave Jones, they're asking if it's sustainable. And his answer is, in the short and medium terms, giving insurers more rate. They're allowed to charge more through their premiums, and reducing their costs should get insurers in California to begin to write and renew insurance policies again, because they're dropping coverage to tens of thousands of people. This is something that they said they would do when they got everything they wanted last year. But in the longer run, insurers are not going to be able to rate increase their way out of climate crisis. So that's the starting point. Now let's go from UC Berkeley News, literally yesterday, to the LA Times. First, they lost their home insurance, then LA fires consumed their homes. So if you think about it, how culpable is the insurance industry, insurers, in maximizing the adverse impact on those homeowners throughout the state of California? It's really despicable. So January 12th, today's the 14th. So going back to Sunday, before the fires burned more than 10,000 structures in LA County, insurers, companies, chose not to renew thousands of home insurance policies in the Pacific Palisades, Altadena, and other fire-prone areas. Rising costs and cancellations of these policies by the insurers left many fire victims without adequate means to cover their losses, highlighting a deepening crisis in the California property insurance market. So then they go into a study of one individual who's representative, Francis Bichetti, talking about before last year, before Francis Bichetti said that he learned that the annual cost of the homeowner's policy he buys from Farmers Insurance for his pet Pacific Palisades home was going to soar from $4,500 to $18,000. It's more than a 3-time increase. He couldn't afford it. Neither could he get onto the California Fair Plan, which again is insurance for homeowners of last resort if they can't get an insurance coverage through a private sector. So the California Fair Plan actually offers much fewer benefits. He said he would have to cut down 10 trees around his roof line to lower the fire risk to get the California Fair Plan insurance, something else the 55-year-old personal assistant found too costly. He couldn't do it. So he decided he would do what's called going bare, not buying any coverage on his home in the community's El Medio neighborhood. And just, I mean, how many people, how many tens of thousands of people were getting priced out of having any insurance coverage? The home he lived in for nearly all his life burned down this Tuesday morning, today. More than 10,000 other homes and structures damaged or destroyed in the worst fire event in the history of Los Angeles. 16 deaths confirmed countywide. It was surrealistic, he said. I've grown up and lived here off and on for 50 years. I've never in my entire time experienced this. Farmers insurance could not be reached for comment. A train wreck coming down the track. So Francis Bichetti was far from the only homeowner in the Pacific Palisades, Altadena, or other fire-prone hillside neighborhoods in and around LA who struggled to maintain their insurance amid sharply rising costs and the decision by many insurers to reduce their exposure, their risk, financial exposure, to catastrophic wildfire claims by not renewing people's policies or even not renewing longtime customers. Many fire victims reported that insurers dropped their policies in 2024. So get this. I pay you, insurance company, and may have paid you for a very long time insurance, because that's what we do. Insurance is a safety net, ostensibly. We pay you, we don't need it. You make a significant profit off of a service we pay for the possibility of needing, but don't. Then all of a sudden there's an emergency. We need you. But right before the emergency, you decide you're no longer going to provide coverage for us because you did all the models and you knew that there was a heightened risk. And we said, we are not going to cover you. I mean, that is, depending on how you look at it, from a purely capitalistic perspective, you say that's logical, right? That's how organizations retain profit. I'm going to tell you that that's absolutely disgusting from an ethical perspective. It is absolutely reprehensible. And that's what's going on in the state of California. So after the fire, the insurance battles, LA victims, ordeal may be just beginning. Now we have to make sure there's not a second financial tragedy that follows the physical tragedy. This is going on right now, this second. Speak to your loved ones, speak to people you know, friends and family in and around LA County. Make sure that they're okay. But this is what's going on. Today is Tuesday. This is last Friday, an aerial snapshot of the smoke coverage of the Palisades wildfire over Los Angeles, California, Friday. I mean, it's insane. It's insane. This is like the largest fire right now, the fifth largest fire in the state of California. California homeowners who lost everything in this week's devastating LA area fires now have to battle their insurance companies to recover the value of their homeowners' policies, if they're lucky enough to have insurance at all. If they are lucky enough to have insurance at all, with estimates of the economic damage from the fires now reaching 52 to 57 billion. So that 10 to 20, we blew that away after a few days. We're at 52 to 57. How high will it go? Consumer advocates and veterans of past disasters say homeowners can expect weeks or months of paperwork to prove that they've lost what they say they've lost, if not also pressure from claims adjusters and a whole class of disaster professionals to make a quick settlement for much less than these individuals were entitled to under the policies that they had. A legally binding document. They paid for an insurance policy that they're not going to be able to redeem in this crisis to get back fair market value. Despicable. The changing climate and increasingly volatile natural disasters it has engendered have thrown the insurance industry into significant disarray, opening the door to a lot of what Amy Bach of the Consumer Group United Policy Holders calls sad surprises. In recent disasters, some of those surprises have involved nickel and diming by insurance companies to minimize payout on claims that they should be making legally. Some have involved freelance claims adjusters or computer programs, AI, thank you. Computer programs designed to cut costs more than to help the consumers, help the paying customer who relied on insurers to provide some kind of equitable relationship coverage in the time of a disaster where they've lost everything. And some of these questionable ethical practices from insurers have to do with the language of the insurance contract. Sure, let's just make it convoluted and complicated so people don't read it, not realizing that the agreement, the policy that they were holding did not provide adequate coverage. We're going to see some funky policies out there, Bach predicted, some language we're not used to seeing. But of course, did you expect anything less, or excuse me, more of insurance companies? And that's for the lucky ones who have policies. Many top insurers citing the destabilizing effects of this whole climate crisis, this global warming thing that certain political groups claim doesn't exist. Many top insurers citing the destabilizing aspects of the climate crisis have been refusing coverage to property owners in areas deemed high risk for wildfires and other natural disasters, areas including Pacific Palisades, Altadena, that have borne the brunt of this week's fire. That's where it's concentrated presently. Thousands of homeowners denied normal coverage may have to depend instead on an emergency state insurance, the California Fair Plan, the insurance program that's costly and complicated to join and caps its payouts at $3 million per household, significantly less than the value of many affluent homes that were completely razed, destroyed, along with all these people's life possessions. This week, matters can only get worse once the accounting for the LA fires is over, as insurers consider whether they need to raise premiums in California even beyond the sharp rate increases they've already requested and received in the last few years. Climate-related extreme weather events will become both more frequent and more violent, resulting in ever scarcer insurance and even higher premiums. A U.S. Senate report on the insurance market warned just last month in December 2024. Climate change is no longer just an environmental problem, it's a looming economic threat. Big insurers, State Farm, Allstate, and Farmers, amongst others, insist they have no choice but to raise rates because of factors including sky-high construction costs and what they call catastrophe exposure, especially in California, where they face regulatory hurdles unmatched in other states. The industry points to State Farm, whose credit rating was downgraded in 2024 as a casualty of these kinds of economic financial pressures they face. Well, this attitude of the insurer saying, we have greater costs, we have to pass it on to you, the homeowner, as you can imagine, it infuriates consumer advocates. They accuse the big insurers of climate change opportunism. Climate change opportunism. And they argue that the cost of deadly events like this week's fires have long since been factored into the premiums. They've already modeled it. They've already schematically game planned it. So it's baked into the cost of insurance coverage. So they've already anticipated, modeled it, the statisticians, the actuaries, they already captured that risk for the insurers into their pricing that they on pass to homeowners. So, ew. So according to the National Association of Insurance Commissioners, U.S. insurers made record profits of $87.6 billion. $87.6 billion in 2023 from their property and casualty business alone, just that line item. In 2024, they were on pace to shatter that record again, making about $130 billion in net income in those sectors in the first 3 quarters of 2024. We've been paying premiums over the past several years to prepare insurance companies for a catastrophe, just like what's going on this week. Whatever they say, the insurers, they have the resources to pay the claims, said Douglas Heller, Director of Insurance at the Consumer Federation of America. Now we have to make sure that there's not a second financial tragedy that follows the physical tragedy. Let's move on to the Daily Mail. So we're going to go across the pond to the UK and see what their perspective on this is, looking back to the United States. Growing anger as homeowners face insurance crisis after companies refuse to pay out and LA residents could face a $115 billion shortfall. The anger of homeowners in Los Angeles is growing as they're facing an insurance crisis as companies could struggle to cover the staggering costs of the wildfires. Tens of thousands of displaced LA residents have lost everything but the clothes they were wearing and a few personal items, leaving insurance companies on the hook for colossal payouts. But customers of one of California's biggest insurers ranted against the company last week after the company canceled fire coverage for thousands of homeowners in the Pacific Palisades last summer, so summer of 2024, in an attempt to avoid financial failure. Now, look, not my first rodeo. I know that your knee-jerk reaction to those who are extremely fair market, the pursuit of capitalism and profit is absolutely fine for corporate America, but we've got to have a consensus on this, that there's got to be some kind of a medium where insurers in the insurance industry and pharmaceutical companies and other companies, gun manufacturers, I mean, the list goes on and on and on and on, right? Across industry sectors, across the whole economic landscape. There's got to be an equaling out and more equitable distribution between consumers and companies. State Farm said in 2023 that it would stop accepting new homeowners insurance applications in California, and then added last year that it would stop covering 72,000 homes across the state due to the growing frequency and severity of wildfires. Comedic actor Rob Schneider ranted against State Farm last week, saying they were a pile of crap for canceling insurance policies. Actor James Woods, whose Pacific Palisades home was engulfed by flames and destroyed, also confirmed in a post that one of the major insurance companies canceled all the policies in our entire neighborhood about 4 months ago, an apparent reference to State Farm, like a good neighbor. Even if residents are still covered by insurance, they could face a $115 billion shortfall due to insurance companies likely only covering $20 billion of the $135 billion in estimated losses. So here we go. The concern isn't whether insurance companies will pay out for damage, but rather how much they will pay and how long it'll take. Amy Bach, executive director of United Policyholders, California-based nonprofit consumer group, told NBC. For the people who lose their homes in wildfires, there will be fights over coverage. So now let's talk a little bit about an actor, producer, director, writer. Tyler Perry blasts insurance companies over greed amongst the LA fires. Tyler Perry speaking out against insurance companies amid devastating LA wildfires. The movie producer took to Instagram Sunday, 2 days ago, to voice his dissatisfaction with insurance providers who have canceled plans in the state as wildfires are becoming, as we've already indicated, much more commonplace. Does anyone else find it appalling that insurance companies can take in billions of dollars out of communities for years and years, and then all of a sudden be allowed to cancel millions of policies for the very people that they became the insurers rich on? As California's become more wildfire prone, insurers have fled the state, making it more difficult for homeowners to safeguard their property. Commenting on the changes, Tyler Perry wrote, "Watching a daughter use a garden hose to try and protect her 90-year-old parents' home because their insurance was canceled was just gut-wrenching to me." In 2024, State Farm, the largest insurer in the state, cut policies in the Santa Monica Mountains, resulting in 70% of customers in the Pacific Palisades, about 1,600 homeowners, losing coverage, the New York Times reports. This is just the California Fair Plan, a state-run alternative to private insurers used by many homeowners who are abandoned by larger insurers, has filled the gap in some particularly fire-prone neighborhoods. At the end of 2024, the state's insurance commissioner enacted a measure aimed at expanding coverage in wildfire-afflicted areas after many companies scaled back following other devastating blazes. California insurance is in crisis. The solution will cost homeowners a ton. So CNN. I do want to kind of talk a little bit about this. Some of the policies that historically insurers issued to homeowners were not renewed by homeowners, according to an insurance industry trade group. But most of the policies that were terminated between the insurance company and the homeowner was canceled by the insurer. The issues continue to build over the past several years. State Insurance Commissioner Ricardo Lara and consumer groups say insurers in California have been refusing to write new policies in areas they consider to be high risk for wildfires, which is pretty much a majority of the entire state of California, which is the 5th largest economy in the world. The rising threat of wildfires and insurance companies pulling back on offering coverage in the large swaths of California at risk for these devastating disasters has become a crisis for homeowners throughout the entire state. And while the state's recently taken steps to address the issue, those new rules are sparking their own criticism because of the increased costs to homeowners. So I had more resources, and I'll put them in the description below so you can kind of check them out, the links to all of the resources from this video, but I'm going to stop here. Look, I am all for organizations pursuing profit. That's fine, but it's the way that it's done. The pursuit of profit is not the end goal. The pursuit of profit is the result of operating ethically and with compassion and empathy and taking care of the communities who you're entrusted to serve, the communities who look to you and to pay you for protection. That's what this is all about. And these insurers understand the risks, the climate change, the increasing temperature variance, the fires that are more frequent and more severe, the damage it's done to homes that people have paid insurance to be covered. And now all of a sudden they're not. And this is just not right. So when I talk about compassionate organizations and building great workplace cultures, there's a reason people, when they hear the phrase insurance companies, it's a visceral negative reaction and you almost vomit a little bit in your mouth. There's a reason that insurance companies as an industry are so reviled. They're so hated, and it's all their own doing. So listen, please, if you like the work I'm doing, if you've seen the 460 plus videos I put here in the last year, please like the video. I appreciate you coming in and checking it out. If you've got some comments to make, pro or con, whatever, please, I respond to all comments. Drop a comment, be sure to like. And if you like the work that I'm doing, please subscribe to my channel. Really, your support will go a long way to helping me to continue to shine a light on organizations that are doing great things in the communities that their employees live in, and they're doing great things for building great cultures for their people. But it also helps me shine a light on industries and organizations who are not doing ethical business practices. So thanks so much. I know that your day is super busy. I appreciate you coming on to check out the video, and please subscribe to the YouTube channel. I appreciate it.